Good morning. Welcome to the morning wrap for the 26th of August 2015. I'm Greg McKenna. It's been an interesting night overnight after the carnage in China again yesterday, when the government seemed to say that it was going to stop meddling in the market and let Mr. Market just do what it wants, which means lower prices for Shanghai. The market finished down 7.6%. That didn't stop Asia from ex-Japan from rallying, and that set up Europe for a really strong night of rallies. Of course, the reserve requirement cut in China, which was announced during the European time zone, helped European stocks rally quite strongly, and we ended up with the FTSE finishing above 3% and the DAX finishing close to 5%. That set the US up for a really strong rally early, up 2% for the Dow and S&P, and the Nasdaq was up 3%. But late in the day, traders reassessed perhaps what the Chinese move really meant, which is 2/5 of nothing really when you think about it. You know, the economy needs more than 0.5% cut to the reserve requirement and a 25 basis point cut to interest rates. This is a structural problem in the Chinese economy, not the mere ebbing and flowing. We're seeing a material step lower in the path and pace of economic growth there. Now, we can say that, you know, whether they're at 4% or 5% or even 6%, that China's growth is still much stronger than everybody else. But don't forget, in China, you've got this balance of where employment and unemployment start to trade off depending on where the growth rate is. So if China really is slowing a lot faster than authorities suggest, then they could have an unemployment problem. So it seems to me that you know, China's still got some issues, and traders in New York probably, you know, thought by the end of the day that they should start selling. So in the end, the Dow finished down 1.3%, the S&P a little bit more, and the Nasdaq down 0.44%. That's really quite a weak, you know, night's trade. Dead cat bounce, if you want to call it that, a huge reversal. And if you have a look at the charts of the S&P, even though the market is still completely overcooked, as you can see here in this chart, you know, from a downside point of view, we've had, you know, 1, 2, 3, 4, 5, 6. This includes futures, by the way. We've had 6 solid days of selling. You know, look at this. You know, the rally came up to here, and then we finished here. This is futures trade now. So the market's completely overcooked, but in a longer term point of view, it's broken its big uptrend. Now this chart here, this 1820 region, is where I've been targeting for the S&P to find its first kind of support. But obviously, if you're a Fibonacci trader, you're looking down here in the 1700s for where just a normal, natural reaction that we see in markets would happen, and that's 1729. It's around that 1730 region. That also equates to the 200 week moving average, which is around the 1704 level. Now, the market hasn't been below that since we bottomed in 2011, when we really got this QE2 rally kicking off. So these are important levels, and you know, we're only 150 points away from it. Yesterday I said I thought we'd get a 150 point rally in the S&P, and the high last night was 1950 off that 1860. So that was only about halfway, so only half right. I thought it had come up to my my fast moving average, but as it is anyway. That's really complicating things for traders in Asia today. Now, the ASX SPY 200 futures for September are up at 5254 at one stage, but they ended up closing down 47 points to 5080. So what are traders going to do today? They're going to sell, they're going to buy. UBS said you can still buy the CBA yesterday, and there will be value pickers. I think it's really worth having a look at my 20 seconds for traders that I write at Business Insider. Jared Manak and David Rosenberg have both, within 24 hours of each other, you know, really highlighted that the easy money, the index buying, the rally because QE is going to make you money is finished in this market. That's the realization that traders have got over the last few weeks. And what that means, it's a stock pickers market. You know, Warren Buffett's going to kill it in this kind of market. There's going to be fear, and stock prices are going to get hammered, and there's going to be gems and all that kind of stuff. I'm a macro trader. So from a stock picking point of view, that's not going to be the kind of market for me, although charts work really well. But it's also the death of lazy investors. You're not going to be able to just buy the index, and that's not going to just make you money. So it's changing the fundamentals. Now, what that means is that the kind of moves that we saw last night, the increase in volatility is going to be more apparent. That's what you see. It doesn't mean it's a full-blown bear market. You know, the US economy is still doing too well for a full-blown bear market, I would suggest. You know, housing prices last night were looking good. Consumer confidence printed 101.5 against 93.3, which was expected. So you can't get too bearish about the US economy per se. But what it probably means is that the overall pace of Fed tightening is going to be pushed back. And so we're all waiting for Stanley Fischer to talk at Jackson Hole in the next few days. And what that does is it changes the dynamics for other markets. It changes the dynamics for the US dollar. It takes the pressure off crude, which has been crashing. You know, it takes the pressure off the euro, which has been rallying quite strongly. Now, the euro's back at 115.25 after having been up at 117 yesterday morning. But what you see is that in this chart, we've had this very nice wedge, which it broke down through, consolidated, it's gone back to the top, roared through, and then found support there last night. I'll be watching. It's not as an exciting a chart if you look at it from a weekly point of view. But one of the things here you highlight, you know, the MACD's been gradually slowing. We've seen a turn in my moving averages. If I blow that up, essentially my directional beat comes from my long-term moving averages, the 15 and the 30. Now they've turned for the euro, which means they've turned for the US dollar. And you can see that euro has been pointing up for some time. So even if we do get some kind of a sell-off, it looks like we might have seen a turn in the US dollar. Now that's important. And Stanley Fischer and what the Fed does are going to be really important. The fact, though, that the Aussie dollar's at 71.18 this morning, the fact that the Canadian dollar's at 133.30 odd, you know, that's its weakest in well over a decade, you know, it just keeps getting weaker and weaker. That tells you that there are still residual fears about what's going on in the global economy. So that means that correlations are going to start to break down. You can't just trade the US dollar. You can trade euro and Aussie, but they're not going to go in the same situation, same direction, I should say. That's a lot more fun. That means that the crosses can come into play. So euro Aussie, Aussie yen, you know, those kind of things. Sterling, you know, euro sterling, euro yen, you know, those kind of things. Gold in euros as opposed to gold in US dollars, gold in Aussie, all those kind of things. This is a good market. This is a really good time for traders. But more than likely, we're going to see continued volatility in stocks and continued weakness. If I quickly go around the grounds, as I've touched on what in the US, the Dow Jones was down 1.29, the Nasdaq down 0.44, and the S&P down 1.35. The FTSE finished up 3%. The Nasdaq, the DAX was up 5%. ASX futures are pointing to an open down around 50 points or 1%. The Aussie's at 71.18, dollar yen at 119. That's probably going to get back down to that 116.5 level, I think. Sterling 156.94. How high can sterling go? Can it get back up to the high 157s? You know, the CAD's on the back foot. It's looking overdone, but still. The foot's come off crude. It's at 39.63. It's still very low, of course, but you know, it's up 2 or 3% from the lows of yesterday. Copper's up back at $2.30 as well. Long gone are those days of $3 copper. So we're still going to get a deflationary pulse. Both crude and copper are really positive for long-term growth on the planet, and I think that's one thing to keep in mind. That's another reason why you may not get a full-blown bear market, but you're certainly going to get a drift lower in stocks. People have fallen out of love with gold already. It's at 11.40, so we'll keep an eye on that. Rightio, well, that's it from me. Watch out for one of the first partials in Australia is released today, construction work done. The RBA Governor, Glenn Stevens, is talking. That could be important, but the most important thing I'll be looking at over the next 24 hours is price action in China today, what the RMB does at 11:15 Aussie time, because that's where the interest rate rubber hits the road. what happens to offshore interest rates in China, and then, of course, durable goods in the States tonight, and what we see from Jackson Hole. So hopefully that sets you up for a good day's trading. Remember what I always say, keep your position sizes and your risk tolerance in line with what you usually want to trade and in line with market conditions. So stay safe in these markets, good trading, and have a great day. I'm Greg McKenna.